The most important thing making money in multifamily is asset management.
Mhm.
Yes, you have to buy it right. Yes, you have to put the right debt on it, but the money is made in managing the asset because the exit value is determined by the your income divided by whatever market cap rates are. You have a significant impact on that income, how well you run the property. So that is where the money is made.
Your network is your net worth. Come listen to some of the most successful people I know share invaluable knowledge, stories, and advice in real estate, business, and beyond. This is Weiss Advice. Whether you want to take your business or personal life to the next level, look no further. Welcome back to another episode of Weiss Advice. I am your host, as always, Yonah Weiss. I am really excited, grateful to have Andrew Cushman on the show. How you doing today, Andrew?
I'm doing well, Yonah. Good to see you again here.
I know we were just at a conference together not long ago, and we're on a panel together. That was a lot of fun. Always going into what's happening in the real estate, the multifamily market. And obviously, you have a lot of experience going through different market cycles, so it's always great to hear your insights on that topic. But for our listeners who may not know who you are for some reason, if you wouldn't mind, give a little background, a little brief introduction.
Yeah. So, like you said, Andrew Cushman used to be a chemical engineer, quit that to go into house flipping in 2007 here in Southern California. That was great, but my wife, and when I say we, my wife's my business partner, but we realized that was, just another very intense job. And because mind you, this is 2007. This is before the apps and you can call 5 people at once and all this fancy stuff you got now. So we said, all right. And then also when you flip houses, you flip a house, hopefully you did it well, you made a nice check, you put it in the bank, but then you have nothing to show for it, right? You're only as good as your next deal.
Yep.
We said, well, what builds lasting wealth and income and what's going to do well going forward? And we said, this was 2010. And we said, well, we just had a huge recession. So that probably means we're going to have a long economic expansion, and half the country got foreclosed on and can't buy a house for the next 7 years. And the other half knows someone who got foreclosed on and is scared to buy a house for the next 7 years. So that means we're going to have an expanding economy and everyone's going to be renting. Let's figure out how to get into the rental world. And we went into apartments. We actually found a mentor and a coach. So we didn't do it completely blind. And our first deal was 92 units on the other side of the country in Macon, Georgia. And we syndicated that. We didn't have the money to buy it ourselves. And 2,700 units later, Yonah, you and I are on panels together in Atlanta. So
That's incredible. I mean, that a very brief topic there, but among other things, I see a surfboard in the back behind you there. Is that right?
It is. I was surfing yesterday morning. So that my philosophy is live where you love to live and invest where the returns are the best and risk is lower. And California has lots of political and natural disaster risks. So
yeah, absolutely. And financial, because
well, yeah, exactly.
It's very difficult to make money on real estate in California due to the high taxes and just the crazy prices and returns are just not very high. So I'm not sure how people will actually do that, but how do people do that? I mean,
well, it's a different game. When we invest primarily in the Southeast United States, and we're looking for a combination of the types of returns that real estate gets you. We're looking for basically immediate cash flow, but we're also looking for the appreciation, and then you have depreciation and all that. In California, cash flow is generally not something that you're going to get, especially immediately. Now, things tend to go up so fast here that it's a long play game, because if you bought something here 15 years ago, the rent has gone up so much that it probably cash flows now, but you're not going to get that right out of the gate. So, I mean, obviously, tons of people have made ridiculous amounts of money in California real estate. It's just a very different game, more speculative. There's other risks to it. So,
right. And it's more long-term, like you said, the appreciation also has been crazy in California. My parents sold their house. I grew up in the Valley in Los Angeles.
You know that?
Yeah. I grew up in Woodland Hills, and my parents sold their house, retired, and moved to Las Vegas of all places. But they sold it for like 3 or 4 times the amount that they bought it for, 25 years ago. It's just like ridiculous.
Yeah.
I mean, not many markets appreciate at that much. That's wild. So talk to me about the multifamily space. We were on a panel recently and we talked about the current market and what people are doing differently right now to stabilize. I mean, you own, 2,700 units, like you said. What are you seeing in your own properties in terms of the stabilization, in terms of, the cash flow, or anything different than has been in the past few years?
Yeah, it's a really bifurcated market, or trifurcated. If it's how's that? I know bifurcated is two. Is trifurcated three? I guess.
Should be. I don't know. Should be.
Yeah, and if not, then we'll make up that word and call it that way today. It's very specific to what type of asset you have and how good of an operator is running it and where that asset is. So I don't operate in Austin, so I will quote the wrong numbers. But I saw that rent there is down. I want to say 7.9. It was someone in that general range, down but let's just call it 7.9%. Year over year, not because Austin's a bad market, but because there's a ton of new supply there. And so you read that, you're like, oh man, rent's down 8%, 7.9%. Well, it is there, and it is in especially Class A assets that are competing with the stuff that's being delivered.
Mm-hmm.
But we are primarily in secondary and tertiary markets in the Southeast US. And that just means not the city. We're not immediately downtown in the city with 5 or 6 million people. We're out in a suburb of that city, or maybe in a town with, 800,000 people. Our rents have been flat to slightly up in the last, let's say, 6 months. We actually never really saw any declines in those markets. We just kind of held flat for a while. There was, out of the 11 properties we're still managing, I think 2 for a period of a couple of months, like dropped rents, like asking rents, like $25 or $50. And then those are now back up. And so now we're actually doing like $25 and $50 increases, which is like a, maybe 1-2% increase. So in secondary markets, tertiary markets, B and A, in maybe A minus assets, we're actually seeing really good operations, high occupancy. I think 80% of our portfolio in the last two months has set a new record in terms of collections. However, again, I already mentioned Class A. If you're in a pocket that's getting, 10,000 units delivered this year and you're competing with those, that's going to be a rough couple of years. And then on the other end of the spectrum, the rougher Class C properties, especially the ones in lower income neighborhoods, that's where you're not only seeing distress from bad loans that were taken a couple of years ago, but you're also seeing operational distress, because those are the people who are already barely making it, and the inflation is just killing them, and their credit card debt is up. They can't make the rent, and delinquency and non-payment is up really high in a lot of those markets. So it depends on who you talk to. Some pockets, this is a really bad market. Others, it's just fine, actually. So
that's a really, it gives a lot of perspective. And I don't think people talk about that too much, especially if you're looking at the news. And I don't pay attention to the news so much, but for this very reason, because it's the doom and gloom, right? They're always talking about all the bad things that are happening and the distress and the apocalypse and all this kind of stuff, right? But like you said, you know your markets, you know what's going on, business as usual for a lot of people.
For a lot, yeah.
For a lot of people. Now, obviously, people who took out, like you mentioned, high interest floating rate debt are in a lot of trouble right now, or are going to be, if not already. Have you done that? I mean, I know have a specific strategy, and I'd love to hear that strategy for you, for your properties, for what you've been doing the past several years. When you saw other syndicators out there, newer syndicators coming to the table, the past 3-4 years, which has been crazy. In fact, I remember one of the first episodes, this is a flashback to about 4 or 5 years ago when we first launched the Weiss Advice podcast. We had a guy, I don't know if you know, Ivan Barrett on the show out of Indianapolis. And he said, there's not a real estate bubble, there's a syndication bubble.
Yes, I was about to say that exact same thing. Yeah.
And those words struck me. And that was 4 years ago. And it popped a little bit. What's your strategy, and how has that differed from say the newer syndicators that were up and coming and are now seeing distress?
Yeah. So, on the surface, our strategy isn't a whole lot different. We do, like I said, Class B to A minus, which for those who aren't familiar with all the classes and all, that's just kind of a middle of the market. It's not the cheap kind of rundown stuff, but it's not the shiny fancy stuff that's just got built, right? So we do the kind of the middle of the market, which is why I was at the middle market forum, right? With Yona. And we're looking for value add, but not just the standard, like, okay, let's go in and put in new counters and floors and ovens. Like we do that, but we're really looking for management plays. So properties that, yeah, maybe have been owned for 10 years and the owners haven't kept up with the market, haven't kept up with rents. That's easy just to keep it full and not worry about it. They don't really need the money. Or maybe somebody, death, divorce, all those things continue to happen. People get distracted from the assets. They don't run as well. So we're looking for some kind of value add. And in terms of, strategy, we did not get onto the floating rate loan bandwagon. And I'll give you an example. So we bought a property in, I think was it 2021? No, I guess it was, I think we closed on it right at the beginning of 21. And that was, interest rates were super low. And I remember we were losing deal after deal to people. And they're like, oh yeah, I got a 2.5% loan. I'm like, how are you getting 2.5%? Well, it's because you're doing the floating rate,
right,
80%, all of that, right? And, we're just like, that just feels like there's a lot of risk to that. And so what we did, I'll give you an example. That property that we bought a 252 unit property in Florida. And, everyone was just, hey, rents are going to go up, values are going to go up, rates are going to keep coming down. This is all going to, just continue like this. And well, we did not see what the Fed did coming. We can't claim to have seen that coming. We thought rates were going to maybe slowly go up. However, when investing, it's wise to never make a decision and just bet on that, but to invest on probability curve. Mm-hmm. So what we said, well, wait a second. Rates are at all-time historic lows. Statistically speaking, if we are now today seeing the lowest rates ever, that means the odds of them being higher in the future are greater than the odds of them being lower. Therefore, we should fix. Like it was just like that was as simple as that. And so like on that property, we got a 12-year Fannie Mae loan that's fixed at 3.79%, which today is phenomenal, right? We're paying 3.79. And you say, well, okay, well, great. You chose to fix. You got lucky. Well, number one, we did. Yes, we did. Two, it was based on statistics, but here's why. We reasoned, well, okay, what if rates go up in the future? Well, if rates go up in the future, we're going to be really happy we locked in this low rate. Number two, the property is going to retain more value because we can sell it to somebody and they can assume this low loan, which is going to look great if rates are higher in the future. And then, what happens if rates do go down? And then I could have gotten 1.5% in the future. Even better because I could go get a supplemental and pull some cash out and the rate on that supplemental is going to be low. Or if rates kept going down, that means cap rates would have probably kept going down, which means the value of the property would have been even greater than we thought. And we win either way. So that's how we structured our deals, which meant, unfortunately, we didn't do a whole lot of deals over that period because, it was hard to win a deal. But the deals that we did do are doing just fine. And the last 6 months, we've been hiring people, because the current portfolio is paying the bills. We're not making a ton because we're not doing new deals, but we're paying the bills and we're hiring people to get ready for what I think is going to be an opportunity to invest in the next upcycle.
So when you say you're hiring people, like who, like acquisitions, people, underwriters, that kind of stuff?
So the most important thing making money in multifamily is asset management. Mm-hmm. Yes, you have to buy it right. Yes, you have to put the right debt on it, but the money is made in managing the asset. Because the exit value is determined by your income divided by whatever market cap rates are. You have a significant impact on that income, how well you run the property. So that is where the money is made. And people ask sometimes, oh, Andrew, what's your guys' edge? What's your specialty? For us, it is that asset management. We're not as good at some other things, but I'm definitely not good at social media. Don't do Facebook, TikTok. I'm the worst marketing guy on the planet. And so we're doubling down on asset management operations. In April, we brought on someone who has been a regional manager for property management companies for decades. And we brought her on now. She's working with us on the ownership side as asset management. When I say asset management, I don't mean the Wall Street style of sitting there with a spreadsheet looking at the numbers. I mean, hands-on, visiting the properties, providing the vision, directing the on-site teams. That's asset management for us in multifamily. We just hired an additional operations assistant So we've added those two people in the last couple of months. And again, the idea is to really improve and hone in on our asset management and then also have the bandwidth to buy new deals. One of the big mistakes that the syndication bubble participants made in that period of time is expanding too rapidly and not, it's easy to buy a deal. Well,
Sure.
kind of easy to buy a deal, right? That's the easiest part. It's what do you do with it after? Right? It's like the dog that catches the bumper of the car. It's like, oh crap, now what? And so many syndicators just bought deal after deal after deal after deal, not realizing it might be passive for your LPs, but it's not passive for you. So
Not passive for them, and unfortunately, not very passive for the LPs at this point either.
no, yeah, unfortunately not. Yeah.
I mean, it's hard to laugh at that, but it is kind of sad to see, people that I know that have lost a lot of money through deals that have just either gone under or are on the way of going under. But the way that you described was smart. Taking the fixed rate debt at those times, I think it was shiny object syndrome for a lot of people. Everyone's doing this, and it's relatively easy to find a deal and pay for it. And even people who claim to have, conservative, quote unquote, conservative underwriting, right?
Yeah, you could have turned that into a drinking game. Basically, like, okay, I'm going to listen to a real estate podcast and I got to take a shot every time that someone says that, they underwrite conservatively. I don't think most people even knew what that meant. Now, I'm actually not a drinker and this is an espresso, but I was just like, I got so tired of hearing everybody say that because most weren't. And I don't think it was necessarily intentional on a lot. I think it was part of the syndication bubble. Just like, well, hey, rents are going up 7%, so I'm just going to plug in 7%. That's conservative. I'm just putting in what the report says, right? So,
yeah, I don't know. It's so hard. Like, where does that come from? That idea that it's conservative underwriting when, it's a completely relative term.
It is. So I'll tell you how I define it. So to me, conservative underwriting means you are making assumptions that have at least an 80% probability of happening, right? So let's say you're investing in a market and CoStar, whatever, says rent growth is going to be 3% for the next 5 years straight. You say, okay, well, I'm going to underwrite to 2.5. Odds are, if the forecast is 3 and it truly is a good market, if you put in 2.5, the odds are high you're going to hit, the market's going to do that, right? If you say, well, I'm going to go 3.5, that's aggressive because you're actually banking on something you can't control coming in better than expected. So you bank
even if you say 3.
Well, exactly. Yeah.
Even if you say 3, right? Because that's, expecting what they're saying. You're relying on that.
Yeah. And that's not conservative. It's not aggressive, but it's just down the middle. So conservative is something that is, your assumptions going in are below projection. Therefore, your assumptions are much higher likely to hit. That's conservative underwriting. And you could apply that to anything. And it's self-storage, multifamily, rent growth, whatever you want. That's how we define it. Like you said, it's a relative term. So someone else may look at it differently, but that's how we look at it.
Yeah, 100%. And in terms of the debt, what's going on with the interest rates right now? Do you see, obviously you pay a lot of attention to the markets and to what's going on with the Fed. Are you seeing any signs of it coming down in the next 6 to 9 months?
I will guarantee you that rates will be higher or lower 6 months from now.
Right.
So, you know what? It's funny. That was one of the things that, when we left the conference, I was talking to some people about it, and depending, you listen to a couple of people give a great argument for why, rates in the economy are going to be lower in 6 months. You're like, yeah, that sounds really well thought out.
Right.
And then you can turn 180 degrees and turn to the other guy behind you and get just as good of an argument of why the economy is going to take off and inflation is going to take off and rates are going to be way higher in six months from now. Jamie Dimon put out his letter earlier this year. Everyone was talking about. And to me, the key thing is not, some of the other stuff he said, but he said he was preparing JP Morgan Chase for interest rates between 2% and 8%. So if one of the smartest financial guys alive today, if his range is from 2 to 8, there's no way I'm going to go out on a limb and say, well, I think I know what it's going to be. So again, if you look at the forward rate curve, which is just the market's prediction of where the market thinks interest rates are going to be. Look at the 10-year, the one for the 10-year treasury. It basically has as we're speaking right now, the 10-year treasury is somewhere right around 4.6, 4.55, something like that. Well, that curve says it's basically going to hang out there for a little while and then gradually go up over the next 10 years, like no going down. Now, that curve is always wrong. Always. Just ask anyone who used it to underwrite in 2021 when it was showing only 50 basis points.
Right.
But it shows you the market sentiment. So the short answer is I have no clue. So again, that's why we invest on probabilities and multiple outcomes. When you're investing, don't make your investment completely contingent on the market or any other outcome going one way. I mean, yes, you do kind of have to decide, well, I think we're headed this way. I think we're headed this way. I'm going to invest based on that, but then I'm going to hedge, right?
Yeah.
So it's kind of like when we bought that 252 unit property I was talking to you about. Obviously, we thought values were going to go up, rents were going to go up. It was going to be a good market. Rates at the time, everyone expected rates to stay down where they were. And we said, we thought so too. Like, yeah, they're probably going to stay low for a while, but what if they don't? Well, let's just fix it and take that risk off the table. That's
right.
what you got to do. So,
yeah, I mean, listen, I don't really know too many people that will say that they know what's going to, think they know what's going to happen. But because, like you said, everyone has a different way of looking at things, and there's a lot of bias in there. I, wouldn't claim to be smarter than anyone out there, but I don't know. It's fascinating to me how people can claim to know, what they're doing.
Yeah, I mean, but to answer your question directly and to not be the two-handed economist who's like, well, on the other hand, my best guess is rates will probably stay pretty close to where they are for the foreseeable future, for the next maybe 6 to 12 months. Yeah, obviously, you've got geopolitical risks that could change that.
Right.
Unemployment. When you have Fed rate hiking cycles, it tends to spike quickly at the end. Like if it does spike, it tends to do it kind of surprise everyone and go really quickly. So that could, change things. But my sense is without some big external event, we're probably going to hang out here for a while.
100%. Yeah. I mean, listen, I guess that's probably the best guess that you can have, right? It's more likely to stay the same than it is to change, right?
Well, today's rates are normal, by the way. Rates aren't high. It's that we're just back to kind of more of the historical norm. So
yeah, what's fascinating to me is when you hear people like talk about, oh well, when they do come down, I'll do X, Y, and Z.
I wouldn't bet on it. It might happen. It could very well could happen, but I wouldn't count on it.
Yeah. To your point about multifamily being your main focus over the past obviously decade plus, have you found any other interest in investing in other asset classes as well, or are you staying in your lane with multifamily?
We're staying in our lane. I'm a big believer in trying to become the best person or best group in the thing that you do. Doesn't mean, I do think there's plenty of opportunity in industrial and self-storage. And I know people who seem to be absolutely crushing it in car washes and, there's oil and gas. So it's not that those things are bad investments or I wouldn't invest in them. I've spent 17 years now in real estate, and my goal is to become even, as best as I can at that one thing. So go an inch wide and a mile deep. So our continued focus is multifamily. Now, within that, will we at some point maybe add in development of multifamily? Quite possibly, yes. But to us, that's just another tool in the multifamily tool belt. So we'd like to expand our knowledge and abilities within multifamily.
So, I mean, does that mean like different markets or different asset classes within multifamily, or what does that mean?
We haven't actually developed yet, but my current vision is we might build ground up, A- apartments. So something like that. Yeah. It would be apartments in the same markets that we're already in. Again, kind of sticking within the same class that we're in, but actually doing, building it ourselves versus always trying to buy something from someone else.
That makes sense. I mean, you have a huge advantage of staying within the same markets that you're already in. Obviously, there's a ton of supply, out there. You have good relationships with brokers probably at this point. You know what's going on, in the markets. You know the communities. You know what's going on with the jobs that are coming in, et cetera. I think it's harder, obviously, to move into a new market than it is to try to get better within the one that you're already in.
It is, and there's more risk when you move into a new market. So
For sure. I mean, and obviously you're at, like you said, 2,700 units. There's probably tens of thousands, probably hundreds of thousands of units available in the markets where you're looking. So it's not like there's a shortage of supply there.
no, well, and again, it's so hyper local. We have a property outside of Atlanta. We do weekly property calls, and every other week the manager's like, I need more units. I've got a waiting list, and I don't have anywhere to put these people. And it just so happens we already own 6 vacant acres of land as part of that property. So it's like, wait a second. Every time we talk to our manager, she says she needs more units. And we already have vacant land that's zoned multifamily. You know what? Maybe we should look into this.
That's a good idea. Yeah. Just build there, bring it up there. Well, Andrew, I'd love to transition now to what we call the final 4. And these are 4 questions I ask all my guests. The first one for you is, what's the worst job that you ever had?
I've been fortunate that none of the jobs I had would probably truly be considered horrible. I mean, other than mowing lawns in the Texas heat, in August when it's 105 degrees and you're out there in the sun. But the job I liked the least was my first engineering job out of college.
Mm-hmm.
The reason is I was working for the largest privately held company in North America. Great company, but the plant that I was at was in the meat rendering district of Los Angeles. And so I had an hour commute each day. I didn't particularly like the job. I knew it was just a stepping stone to a better one down the road. But it was in the meat rendering district, which some of those plants made meat food, but some of those plants also were where they took all the roadkill from Los Angeles, brought it to the plant and melted it down to make, grease and pet food and all this other stuff. So the last couple of miles of my commute, I had to drive past those plants and the speed limit was 45. I literally used to take a deep breath, gun the car and try to make it to the end of that street before I had to take another breath. I'd hit 70, 75 every single time, just trying to get, it smelled so bad. And my wife, my girlfriend, and then when I got married, she's like, is it really that bad? And then one day she realized when I came home, you could actually smell it on my clothes just from driving through. Like that's how bad it was. So that was my worst job ever because the job was okay, but the location was horrid.
Oh, that's disgusting. Just thinking about that. I didn't even know something like that existed in Los Angeles, but I'm sure.
Yeah.
I haven't been to
Vernon, the meatpacking district. Yeah.
Wow. Okay. That qualifies as the worst job for that reason, for sure. What is a book you've read that's given you a paradigm shift?
It's an older one. It's called Start with No by Jim Camp. And I'll give you a quick example. So, let's say you go to a car dealership and you're like, hey, I'm looking for a car. And they're like, oh, we got the perfect car for you. You know what? We just marked it down. We're only going to get, it's only good for today. So, why don't you come over here? We'll start on the paperwork and, we can have you out the door of this car today, right? Which is the whole getting the yes, close, right? Your guard is going to immediately go up and you're going to be like, whoa, hold on. Whereas if you go to that same dealership and you're like, hey, I'm looking for a car, they go, well, we might have something that you're interested in. So, let's go take a look at it. But, as soon as you have any reservations, just tell me no. You don't have to buy it today. In fact, we recommend you take some time to think about it. Again, it might not be for you, but if you want, we can go take a look at it. You're going to be much more open to listening to what that salesperson has to say. You're going to be much more comfortable with working with them, right?
That's fascinating.
It was a flip so that's a start with no, because that no is actually one of the most comforting words in a negotiation. And that book was a huge piece of how I successfully did the flipping business. It was telling people, no, I'm not here to buy your house. Right. And in 99% of the time, I wouldn't buy their house. But it was a paradigm shift. It's a fantastic book. And then most listeners have probably heard of Chris Voss.
Yeah.
He's been really popular the last few years for good reason. If you read his book, Never Split the Difference, he quotes and talks about start with no many times over.
Yeah, I do recall that. Actually, I think he has a whole chapter devoted to that. That's fascinating. Awesome. Well, I'm going to put that on the list and in the show notes for anyone who wants to start with no. Check it out. Third question, what's a skill or talent that you would like to learn? And this could be anything.
I'm gonna give you two. On the personal side, this is probably really common, is I am in the process of learning Spanish. A year from now, I'm gonna be able to hold up my phone and it's gonna be a live, real-time translator, but I still want to know Spanish. So I'm learning that. And the second is, we touched on this, I want to learn development. Not that we're just gonna always do development, but I think that's a valuable tool to have in the tool belt and would also be, an exciting thing to do.
That's awesome. Yeah. Well, I mean, first of all, the Spanish thing, a language is huge, especially, I mean, living in California helps to know Spanish for many reasons.
Yes, that is part of it. Yep.
But the development side, that's a lot of fun. It's a lot of opportunity there. Well, good for you. Good luck with both of those. And I look forward to hearing developments on those, no pun intended. Fourth and final question, what does success mean to you?
To me, it means living with intention and integrity. I know guys that their goal is to be a billionaire, and I know other guys who made a few million and they're like, I'm going to go ski and enjoy my family and my good health. And both of them to me are quite successful. So I think it's a lot of people, unfortunately, especially in the comfort of America, just kind of live the same day over and over again, just wake up, do the same routine, don't really think about it. And I think that's why we have a midlife crisis, right? Like all of a sudden you wake up like, oh my gosh, 35, 40 something years has gone by. So living with intention, say, I want to do this with my life. I want to do this with my business, this with my health, this with my family, this with my, with my spiritual beliefs. So having that intention, but then acting and speaking in a way that matches up with that, right? So for me, that would be, if I'm living with integrity, that would be other people see me and say, okay, he is a good husband and he is a good father and he does behave like a Christian and he does the best he can to do good deals. All of those things I just listed are intentions that I have, them trying to do. And so living with integrity would be, your words match your actions. Your yes means yes, your no means no. And that is evident. And so to me, if you're doing those things, that's success. It doesn't matter if that you got 100,000 or 100 million or, one kid or 10 kids or whatever it is. How that actually plays out, I think is different for different people, but that's one way I define it.
Wow. Yeah. I love that. Living with intention. And it's so true. I think that really is what it comes down to. So appreciate your perspective on that. Finally, Andrew, where can our listeners find you or reach out to you?
You will not find me dancing on TikTok or on Instagram or on Facebook. Well, on Facebook, about twice a year, I'll post a surfing or a skiing picture. But in terms of actual content, I do LinkedIn. I learned from my buddy Yona here that, LinkedIn just seems like a good fit for me and the place to be. So yeah, please follow me on LinkedIn. And if you comment on something I post that is me responding, it's not an AI bot or a virtual assistant. So if you want to actually have a conversation, let's do it on LinkedIn. That'd be great. And you can also go to our website, Vantage Point Acquisitions. It's vpacq.com. There's a couple of tabs on there for how to get in touch with us or learn a little bit more. So
awesome. Well, we'll make sure to put that in the show notes. And if anyone wants to reach out, I highly recommend it. And Andrew has some incredible content on LinkedIn. I would say he's putting out stuff on the markets and on what's going on in the multifamily world on almost a daily basis and really high quality stuff. So highly recommend you give him a follow and check it out. And, thanks again for joining me on the long time coming, but I'm glad we were able to get it scheduled.
Yep. Yeah. Good talking with you, Yona.
And to our listeners, thank you guys for joining and listening in all the way to the end once again. And remember, until next time, the best advice comes only when you ask. Real quick, I have one question for you. Did you like this episode? If you did, I want to ask you a huge favor. See, the biggest thing that helps this podcast grow and that will spread this message to the whole world is that if you leave a review, a rating, and subscribe to the podcast. What that does is it basically tells the platforms that this podcast is out on is that you like my stuff and I'm doing something right. So take a few seconds out of your day, hit that subscribe button, leave a rating or review. I would be extremely grateful. Also, I want to hear from you guys. So I want to hear some feedback. If you have any questions for future episodes, please find me on LinkedIn. Send me a DM, connection request, Yona Weiss, and I'd love to hear from you.